Good afternoon, everyone, and welcome again to the Fiscal Health Program Systems to Sustainability webinar, part number 2 on indirect rates. My name is Jamie Rose. I'm the project manager for this program. Today we will go through the various steps to build an indirect rate and finish the indirect rate schedule. Paul Calabrese is back with us today to do second part, so I will turn this webinar over to him. We do want this to be interactive, so if you have any questions during the presentation, you can go ahead and click it, write your question in the chat feature, or you can click the raised hand button on the right side above your chat feature, and we'll unmute your phone to ask your question. So without further ado, thank you, Paul.
Hello, everyone. Happy to be here, and let's go over the second part, which kind of builds on last week's part of indirect rates for nonprofits, and we'll be using the HHS model. If for some reason you can't hear me well, try to up your volume. We've been having a little bit lower volume issues, so if my volume isn't loud, try to push it up all the way. Thank you. So we're going to go over indirect rates part 2. We're going to try to use a real live nonprofit and use those exact actual schedules that will hopefully help you a little bit in seeing maybe how you might develop your indirect rate model. So the highlights today in our agenda is to develop an indirect rate, but this time we're going to use a real nonprofit. We'll look at something called a cost accounting matrix, which basically is kind of aligning your chart of accounts and your departments together so that they are meaningful for developing indirect rates. We will look again at the DHHS, the HHS model template, but this time for a particular organization. And we'll look at their post-audit trial balance. We'll look at reconciling all the costs to their audited financial statements. And then this particular organization had a very detailed schedule of functional expense, and they had all kinds of information on there adjusted for unallowables on an OMB basis, not a GAAP basis. So it'll be a little bit different than a GAAP basis, very close. And we'll calculate the indirect rate, and then we'll look at what a negotiated indirect rate agreement document looks like. Sometimes we call it a NICRA. So our objectives today, like the last time, is to provide you hands-on skills and tools for developing an indirect rate. But we'll use this time a real organization's documents, accounting documents, and I think the third bullet is the real key here. We're learning what documents are involved and how to use them to develop an indirect rate. So the key is, as we start, you're going to see this right up front. What documents are we going to use? And then how do we use those documents to develop the indirect rate? And that is the key. Here's some contact information for me. So let's get into it. If I were the consultant and I was to come to your organization and develop an indirect rate, these are some of the items that I would look at. And so it's the same way of giving you intuition and insight into your own organization and the types of things we would use to develop your indirect rates. Most definitely I'd look at your what we call post-audit trial balance. The post-audit trial balance is simply after the audit's done, if there are any audit entries that are entered into your books and records, your trial balance will then reflect it. And of course then the trial balance will equal the audited statements. So that's why we got to let the audit be finished first. So I would look at your last year, full year, fiscal year trial balance, as well as maybe the current years. I would certainly want to look at your chart of accounts and your structures, how you're set up. I would look at the last fully completed audited financials and focus on the statement of functional expense. So I know there were 3 entities that were looking for perhaps a little assistance from Health HIV, and I'm almost sure all 3 of you now are in the process of either your draft audits were pretty much done for 6/30/2012, or they're just being done as we speak. So this is a good time. You wouldn't want to work on 2011 if 2012 is almost done. You'd just be wasting your time because the government wants the most current information. Your annual budget has some help and assistance here, and we'll talk about that. Certainly, you would want to look at grant documents for any cost limitations. Many of you who are in the Ryan White world, you know that Part B or some of those parts limit administrative cost to 10%, so that obviously has an impact on your indirect rate. The reason you may be looking at it in spite of that is because maybe you're looking at other non-Ryan White and um, opportunities. And if I heard correctly, the Affordable Care Act is replacing some parts of Ryan White. So again, you're looking to maybe CDC. You could even be looking to other agencies like Department of Justice. They have some of these types of programs and so forth. Another thing I'd always look for, and of course all of you would know best, is has your agency in the past maybe had some negotiated indirect rates, and if for whatever reason they didn't update it every year, or perhaps uh, if they didn't update it every year, perhaps it's just something that was done once and that was it. So let's look at the what we would call the post-audit trial balance, and last year is probably the most important. If you're going to develop an indirect rate, you want a full year of information. Indirect rates apply to the whole organization, not just some specific program, and they apply for an entire fiscal year. The best is the most current. The most current historical information is the best. If you wanted to work with the current year, really 6 months may or may not be good enough information because your rates vary. But by the 9 month interval, certainly they're locked in. So, if the 9 month was going to say that your historical rate was, 12%, it may not vary that much, after that point because you have cumulative information. And then you might want to make it a 12 month by adding what's left of your budget. But the government doesn't accept these hybrids. They would only be good for internal use or some projection. They like to see a full year of historical data. Your prior account structure may not be too useful either for rate development. If you're a very, very large organization, your organization probably is very logical. Smaller ones may have a bunch of accounts and just too many accounts, and it's not efficiently set up. If you are and can take a stab at improving your system, you certainly would want to improve and simplify your chart of accounts. Because that reduces work for your accounting staff because they're not looking for the account number. It's pretty much straightforward. I'll explain developing a matrix of GL and departments, but that's what we call a cost accounting matrix. It's just a term I came up with, where you got the GL accounts, which are like the rows, and the departments are like the columns. Anything you can do to standardize makes it a lot easier, and it becomes the basis of your new accounting system. You can integrate and should integrate this into your annual budget as well, so your budget reflects the new chart system that you have of accounts. And of course, you may have many pages, but try to fit the summary information on one page. When you're starting to read 2 and 3 pages, it's hard to make sense. The schedule of functional expense you're probably familiar with, or statement of functional expenses. They're detailed expenses from the statement of activities. They're greater detail than like a 990. The rows represent expense accounts. The columns represent departments. Programs may be summarized on a variety of functions. Support services, including fundraising and management in general, are separated. And so in the next slide, you get a sample of this. So in this case, what we're saying is, on the left side here, you're saying personnel expenses, the salaries, and then the fringe benefits, although they call it payroll tax and benefits on the left side. And then below that is the non-labor expenses as well, and then the rest is total. You're seeing program A, B, and C, and those are all direct programs or direct items within the way that the OMB looks at it. Now, fundraising over to the right, that would be moved right between program C and total program expenses. The reason you'd remove program fundraising over to the direct cost side is, as I shared with you last time, fundraising, membership costs, lobbying, those types of things are all considered a direct functional area. for purposes of OMB purposes for developing an indirect rate. So fundraising comes over, it becomes a part of your total cost base, and only management in general sits over there as an indirect. So this kind of gives you that idea. Now, and I'll be talking in a future slide, you could actually take the sum of your total expenses, compare them to your revenues, and then you can try to figure out, well, is program A, B, or C, or fundraising, do I have a positive net assets or residual, or do I have a negative? Because what you would do is you take your management in general and you apply it, let's just say it's 10%, so you apply 10% to total expenses of program A, B, and C, and what happens is this column just disappears, and as well as fundraising. And you apply those expenses. Once you had total expenses, including indirects, compared to your revenues by program A, B, or C, or fundraising, and see whether you have a plus or minus net assets or residual from it. So this kind of format is so important because you're going to see it in the HHS model, as you saw last time, as you'll see this time, but then you'll see it on a greatly expanded basis. But this is the format the government wants you to use. So developing a statement of functional expense and having it in your audit are critical. And to some degree, your annual budget could start to take that format of schedule of functional expenses when you're dealing with the expense part. And again, in the bottom bullet, you can modify it to put revenues, compare revenues versus total expenses, and get a bottom line number once you've applied your G&A. So these are just things, once you have a budget, you could use it to project your indirect rate. Again, the government tends to want to use historical data. If you were going to look back at prior rate agreements, what they would show you is how the rate was previously computed and the allocation base that you might have used, which we talked about last week, the cognizant agency and contacts, any special limitations, what years it applied to, what the new provisional rate was, but of course it may be out of date because it's a long time ago, if you had such thing. Cost accounting matrix is really nothing fancy. It's just the framework for developing your cost accounting system and your indirect rates, and it should facilitate the basic requirements of your project cost or job cost system for activities. So separating cost and funds between grants and programs and services and membership, fundraising, and the like, distinguishing what's direct and indirect, that has to be kind of intuitive and built into your accounting structure and your combination of your rows, which are your general ledger accounts or natural accounts, as compared to your departments. And then identifying and segregating unallowable cost as well as direct or indirect. So, they want you to identify if there's any unallowable expenses as well. This is the basics of a good system. Sometimes people set up cost accounting systems that look like this, where you have salaries, fringe, supplies, communication, and so forth, and then you would drill down and to get to specific general ledger accounts. If you deal with subawards, then subawards would be things that you would want to deal with as well. So subawards here would be things like anything greater than $25,000 over the life of the subaward. Well, that becomes not included in the base. So anything, here we go, this is better. Anything greater than $25,000 over the life subaward or subcontract if it's less. And so what you may want to do is set up two accounts so you can kind of track, well, something went over $25,000 or it's less than $25,000. So if you have a modified total direct cost base, you would know whether to include or not include. This is just an idea, suggestion, not something you have to do. Here's a simple way to do it. This is something that could be done in QuickBooks or Peachtree, where you have $4,000 as your revenue, $5,000 as your direct cost or cost of goods sold, $6,000. So direct costs would be direct labor, other direct costs such as travel, participant support costs, supplies, any other kind of thing that fringe that would apply to direct costs. Then you'd have a pool for gathering all your fringe benefits in $6,000. $7,000 could be reserved. It could be occupancy if you have to segregate occupancy. It could be an overhead, some intermediate thing, or it just may not be used at all. Because most organizations that are small, they need a fringe and a G&A, which would be your 8,000. 9,000, you would set up maybe just one general unallowable expense. By setting up that one simple account here as an unallowable, what you're really doing is letting the government know that you know there may be some unallowable expenses, and basically what you're trying to do, is letting them know that, hey, I've got some unallowables included in here. Just something to think about. This this simple structure would facilitate a rate computation. If I did this stuff, I could quickly figure out very, very quickly an indirect rate. I probably could produce an indirect rate in 15 minutes if I had the Excel in this format and had it put into Excel. Okay, so now what we're going to do is get into some of these documents. I have a second document besides my PowerPoint. I have this large document which you are able to receive if you haven't received it. So when you get the documents for today, like the last time, you're going to have a PowerPoint document which may be in PDF, and then you're going to have supporting documents with this presentation. And the rest of our time is going to be spent pretty much on working on the real life costs and dealing with how do we develop this indirect rate. So the first thing I wanted to show you is that many of you are bidding on federal grants and private foundation grants. And some of you may be misclassifying that as fundraising. You may think that all costs that are raised for the entity is generically fundraising. When I think of fundraising and the government thinks of fundraising, we're talking about fundraising like an event. Like you have an annual banquet, you have an annual, whatever they call those things where, you guess the price or you set the price, an auction, those kinds of things, or, you have a bike race or a 5K race or something. You're doing something to raise money, or you have general contributions and so forth. That's not what I'm talking about with fundraising. What I'm talking about is grant proposal writing and so forth. So let's go to this document. And this document basically says that, let's go down a little bit, okay, I have some guy looking at me. We have directions every 5 minutes. He probably wants to see if I'm still awake. But in any event, I wanted to show you that your grant writing and grant proposal costs, whether for a federal effort or a non-federal effort, is allowable. Now, let's start with how that works. And that's why I'm on this PDF here. If you notice in there, there's if you go to the terms and conditions of your grant, especially if you have HHS awards, it's probably going to tell you almost like this: 45 CFR Part 74. That's your A110. You got to follow it. 92 is for state and local units of government. The HS grants policy statement is also something you must follow. Okay? So you're going to tell the Division of Cost Allocation, look, I think bid and proposal is allowable. And they're going to say, no, it's not. And then what I did was I showed them, well, but I have to comply with 45 CFR Part 74. That's my A110. They say, oh, that's interesting. Now, when I go to A110 within HHS's version, there is something called 74.27. And 27 is allowable costs. And it says that A122 doesn't deal with bid and proposal or independent research and development. But it does define bid and proposal as costs that are immediate costs of preparing bids and proposals, applications for federal and non-federal, not only contracts, but other agreements, including development of scientific costs and other data needed to support bids, proposals, and applications. So when you respond to a grant, it's an application. And so other agreements, well, that could be a cooperative agreement, it could be a grant, it could be anything. So whether it be federal or non-federal, what I'm trying to say to you is that bid and proposal for preparing indirect, excuse me, no, bid and proposal for preparing grant proposals, whether it be the cost part of it, the budget part, or the technical, all of that application is allowable as long as it's in the current accounting period, and it's an indirect cost. So you can't recover it direct, but you can recover it indirect through your G&A. So obviously, if you don't have a G&A, you won't be able to recover it. Ergo, why we're doing this today. So if you thought that what you thought grant proposals, grant writing was a fundraising, it's not fundraising. It's bid and proposal, and it's allowable not only for federal awards but private, non-federal awards. So that could be like Robert Woods Johnson, Kaiser Foundation, whatever you're dealing with. That stuff is also allowable. And that's what I want to present to you today. So a lot of people who are doing this stuff, they're not recovering it, A, because they don't have an indirect rate, and B, they may be misclassifying it as fundraising. So I wanted to bring that to your attention. Let's go back to the PowerPoint for a second. I'm going to be calling this nonprofit Helping Hands Non-for-Profit. That's what we're going to refer to it as. As you see, they're real documents. They had a particular issue before we get involved into it. And this is their issue. We'll switch to the next slide, and then we'll come back to this list. Okay. Before I do this, I just have this funny feeling I better go to the next slide, the next thing within the PDF. Okay, hopefully you can see this. This is the rate submission Schedule C that we looked at last week. And I think this is illustrative so I can explain to you. This is DHHS's model in developing an indirect rate. Let's see if I can move this up a little bit. No, I can't. If you notice here, this again are the numbers that line up with the financial statement. No different from your statement of functional expenses, and they're the grand totals. The top is the labor and fringe, and then the non-labor items, and you get the total expenses. That's how it works. The column C is any adjustments, any unallowable expenses. So from column D to column I is the universe of computing your indirect rate. Column D and E, and this is like a federal award. E is a private weatherization, and G is obviously private to the nonprofit in membership and fundraising. All of these are your total direct costs, which total $2.175 million. Okay? These are your direct costs. Your indirect costs is column I. And it totals $382,200. And we went over this last week. We said there are three different kinds of bases that you could use, if we recall that process. Okay. The three different bases. Remember, 382,200 is your numerator for your indirect rate. See it here? This is for just a direct salary base. The second base, same pool, same numerator, 382,200, but over a larger base, which has direct salaries and fringe benefits. And the third one, same pool, 382,200 for indirect, but over a bigger base, 2.175 million. Notice the rates change. The smaller the base, 1.1 million, the larger the rate. The base starts to grow to 1.3 million, the rate starts to diminish to 29.1, and then the largest base, the modified total direct cost base, 2.175 million, the rate 17.6%. Hopefully, I haven't lost you, and most of you see that, and that makes sense. So in this simple rate computation, the direct costs come from here. You could have taken the 1.1 million, which is total labor. You could have taken the total labor and fringe, which is this number, 1.1, and looks like 202 to 1.3 million. And that was the middle number. See, this is the first number, 1.1. 1.1 is up here. And then the last is 2175, and that's all the labor, fringe, and non-labor expenses.
Paul, it's
So
Jamie. If you don't mind, when you're pointing the numbers, if you could use that pencil so we can see when you're pointing at the numbers.
you can't see it? I'm moving it
No,
now.
no,
I
sir.
have it on the screen, so I don't know why it's not. Can you see this arrow? You can't
No,
see
I
the
can't.
arrow.
No.
I don't know why it doesn't show it, because like now I've clicked on the pencil, but I guess unless I do this, you don't see anything, right?
Yeah, you have to scribble there. I can see that scribble there.
Okay, good enough.
All right. Thanks.
Okay, so let's take this number here. Maybe you see that circle. That's the 1.1 million. That's the labor base. Down here at the bottom of the page, I'm sorry, but it's a little bit small here. Maybe you can see again where I'm circling the 1.1 million. So that's where that base comes from. That's the total labor base. Let me also do something else. Let's change the color here. This 1.3 million, number 2, that includes labor, and it includes this 202 and fringe. That's where you get the 1.3. That's down at the bottom of the page on your bottom left, 1.13 million. And the numerator, the same numerator in all three, the numerator of 1.13 is 29.1%. And then the grand total, 2175. You see that on the right, okay? That's your biggest base. That's the total modified direct cost base. And at the bottom, there it is again. Same pool, 382,200 over 2.175 million. That gives you 17.6%. So now you see that basically this is a very simple model. Your direct costs are in the middle, okay? Your indirect cost, the way this is set up, is on the end. And column H is just the sum of your direct costs. So I divided by H at some level is going to give you a rate, and that's it. Remember that column B is just reconciling to your financial statements, which is 2.6 million in this case. And C is your unallowables. So from D to I, that's the universe. That's the universe of our indirect rate submission. Now, what I'm going to explain to you now, let's go back to our PowerPoint. The nonprofit we're dealing with had some unique issues. You may have these unique issues as well. You're probably saying to yourself, if I can get rent, some of my rent charged direct, I'm going to get greater cost recovery, and I have no indirect at this point. So unless I have some allocation to get it under my budget, if you remember from the last presentation, there's under the grant budget, there's labor, there's fringe, and then there's other. So unless occupancy is allocated as other, I've lost my chance to recover rental costs. So in this organization, they were able to recover the rental costs as a direct cost because they said for every FTE, the rent cost is so much money. And since they could say, well, we're proposing 2.5 FTEs on this grant, they had a line for other direct costs for rent, direct rent. The problem is that not all funders gave them rent. Some federal and non-federal funders gave them rent and approved it, and others did not. So they had this kind of two-pronged situation. They had direct rent that was approved on some awards and direct rent that was not approved on some awards. Now, if I'm going to develop an indirect rate, what happens to the direct rent that's not approved under the awards? Well, it winds up into your G&A pool. So your G&A pool is going to have two kinds of purposed rent. It's going to have the direct purpose rent that was not recovered directly, and some rent that's for indirect purposes that supports the G&A staff. So, and then I'm going to have some rent that was allowed direct. So you can see I've got kind of a matrix. I've got three different scenarios of rent, and that's what these three different colors really represent, as I'm going to show you in a minute. So again, they had some rent. They could recover some direct, on some awards and some that wasn't. If they develop an indirect rate, then indirect rate's going to have two kinds of rent. It's going to have the direct rent they couldn't recover as a direct cost, and some indirect rent, which is fine, which is normally supports the G&A staff. Now, if I'm going to develop an indirect rate, there's a problem, and it's hard to explain because I don't have a whiteboard in front of me to explain to you, but I'll try to go very slow. Normally, and let's go back to this model. Normally, if you use in the bottom left, if I use this methodology, what are we using? We're using a modified total direct cost base of 2.175. Well, that includes up here occupancy. And I bet some of the occupancy as it goes along was direct. Okay? So it's including some direct occupancy. It also has some indirect occupancy in the G&A. This is fine because this piece is of an indirect purpose, and this piece in here is of a direct purpose for rent. So rent being for an indirect purpose being in G&A applied over direct purpose rent, it's not a problem because the purpose is different. One's indirect and one's direct. However, if I have some in G&A, and we're just going to make this up, that's direct purpose that I couldn't recover direct, now what happens? I'm applying direct purpose rent in G&A to a direct rent, and that's double charging. Again, if I have some direct purpose rent that's sitting in G&A that I couldn't charge direct to an effort, okay? If I couldn't charge it direct and it sits now in G&A, if I develop a G&A, this direct purpose rent that couldn't be recovered direct and then is now being applied through the G&A rate on a modified total cost basis, which means it goes to ODCs, other direct costs, as well as direct labor. It's double charging because this amount here is going over to this, and it's for the same purpose except one's sitting in indirect and one's sitting direct, and that is double charging. That is the something we have to avoid. And sometimes organizations such as yours, you may have had this kind of situation where you said, gee, you know, I have direct that's rent, but I also got a bunch of direct rent that I never recovered. And if I develop an indirect rate, it sits in G&A, but that would be double charging. And that's what you have to understand. That's what we have to stay away from. And so this is the best way I can explain. So what happens is, well, let's just change the color here. I know this is all a little marked up here. Okay. So to avoid this problem here, I'm going to use a different G&A base. I'm going to use this G&A base here. Now what's this G&A base? This G&A base at the bottom is what? It's 1.13 million, which is made up of direct labor and applied fringe on direct labor here in the right. So that's what I'm going to do. Why do you use that method? Because when I apply indirect purposed rent and direct purpose rent, it doesn't hit an other direct cost. Other direct costs are removed. All I have is salaries and fringes. The other direct costs that were in this bigger base at the bottom, I'm not using. So sometimes people use a different kind of allocation base because what they're really trying to do is also avoid double charging, and they're trying to make their cost allocation systems consistent, because that's a big thing you may have forgotten, but the very first slide of the last presentation related with talking about there's certain rules, and consistency is one of them. So I hope that's not confusing you. I hope it makes sense. This organization that we're going to talk about today, that I spent a little time on kind of explaining it to you, is they use as their allocation base, their denominator for their G&A rate, they're using a direct salary plus applied fringe. Now they could use a direct salary base, but they wanted to apply the fringe to kind of make the base a little bit larger and make the rate lower, because even in this make-believe example, the difference here is about 5%, a little bit 5 plus 0.3%. So They wanted the rate to appear a little bit lower because higher rates are misunderstood by people. So they went with the middle line rate, and that was accepted by DHHS. And I explained the same criteria to them that they had some direct purpose rent that was charged direct, and then they had others that would be in G&A. And they said the only way you really can do this is you got to use a salary and fringe or salary base, direct salary base. You cannot use the modified total direct cost base because then direct purpose uh, rent gets applied to direct rent, and that is double charging. So hopefully that kind of scenario and that explanation makes sense to you. Now what we're going to do is go back to this PDF and look at this slide here. The first slide, the first part of this box we have arranged this statement of functional expense, which you're going to see in a minute. It's a very large 6-page spreadsheet. In fact, if you were to print it out, you'd print it out on legal paper. And to apply, they had in this first layer a bunch of programs that were aligned together, and we color coded it to make it simple to the eye. And so in the first layer, the purple at the bottom, it includes direct rent and direct joint costs. There's just a few joint costs. The joint costs aren't that many items, like utilities, local long distance telephone, and some office and computer supplies. So they had, because I wanted to make it simple in explaining it, they had two kinds of items that they could charge directly under the grant award agreement in their budget, and they were approved. Rent was one of them, and all these miscellaneous, what I call joint type costs as well. The second layer they had, which we put as orange in the middle of the slide, they had joint costs that were still direct on a bunch of jobs, but the rent was not permitted to be charged direct, so it wound up indirect. And in the third, the highest level, they had both rent and joint costs that could only be charged indirect. There were no jobs in that grouping, or projects, excuse me, that could be charged rent could be charged direct, or joint costs could be charged direct. So basically all we did was color code, which I'll show you in a minute. We color coded it so that we could, through visually, we could see that the green was rent and joint costs could only be indirect, not direct. In the second one, the orange, only joint costs, a few of them could be direct, but the rent was still indirect. Only in purple could the direct rent be direct and indirect. The direct rent could be direct and the joint costs be direct. And this will be important as we set up our rates. I'm going to show you an example now. Let's go back up and over. Oop, don't do that, don't do that. Okay, cancel. Okay, let's go to the next one. I'm going to skip this for one moment, and I just wanted to show you, this is the document we're going to use. So if you have a way on your screen of enlarging it and making it clearer, you may do so. I'm going to make it a little bit larger for myself, which may not be clear to you. If you notice at the top, in these areas here, they're all purple. If you look at this line, just this line here, you'll notice this is where the rent is. Notice it's direct. It's a direct charge. And notice these other three items here. These three items here are miscellaneous joint costs, such as utilities, such as telephone, such as office supplies or computer supplies. Rent is right here. So in this grouping here, rent is purple. We put it in because all these costs are direct. And then we'll just kind of page forward here. The orange, you can see that the rent here is now 0, as we said, although there are certain joint costs that are still possibly here that are direct. And then we get into the green. And this is sometimes what people do. What they're trying to do is align things so that people can see. Here we go again in the middle of the page. This is just a 6-page thing, which means there's 3 on the top level and 3 pages on the bottom. And you'll notice everything here, all the rent and all the joint costs are 0, meaning that they had to be pushed indirect. So this just gives you a sense of what they're dealing with. That's why we had to do a rate development that was based on a salary and fringe base. We could not use a total modified total direct cost because there'd be some double charging here. So I just wanted to explain this to you. We're going to go back to this in a minute. I wanted to show you for this organization, which we can call Helping Hands Not-for-Profit. This is what their audited statement of functional expense. Yours might be greatly expanded. Instead of this people putting in program, admin, and fundraising, and the total for 2010, okay, they may have gone further in defining many different kinds of programs, but in this area they decided not to do that. So this is a very small entity. It's only 2.4,609,000. That's the control number. And then you see the various line items, salary and benefits, and then down the line they go. Okay? Now you probably will notice something else here, the overhead allocation. So it looks like what they did was they took a certain part of administration, not all of it, but they took 125,982 and they moved it to program, 103, and 22,000 to fundraising. But after they removed that, you still have a plus balance of 99,502. So what I'm trying to share with you today is that for GAAP purposes, GAAP wanted to leave some of the administrative costs into their what would be their administrative cost center. For our purposes, for OMB purposes, we would remove all of this from here, all of the costs from admin, and throw it to program or fundraising, or many programs. So that's one thing I wanted to show you right away. The second thing you notice is that if you go back to their spreadsheet, look at it. They've got, I think, over 40 or 50 different cost codes here, if you can see that. They got many different program codes. But when you go back, again, you see that for program, they summarized all of it. They summarized any of the admin area and the fundraising area to just these three columns. That was the way they wanted to present it. The grand total of this audited statement of functional expense is 2.4 million 609, and I wanted to show you that the grand total here is the same. That there's really absolutely no difference here. So if we go through to the very last page, you'll see down here, depending upon how it's blown up, you'll see that the grand total here at the bottom is 2,400,609. The same with this, maybe off by $1. So again, however you do this analysis, it's very important. Everything reconciles back to the audited financial statements. If it doesn't, the government's going to have a problem. Not going to be very happy about all of this. So it's just something to think about as you start to develop your numbers. And remember that it can be done. There's two bases to be done. There's a GAAP basis, and then there's an OMB basis for developing your rates. So they're going to be a little bit different. Okay. Now what we're going to do is go through the fun job of this mega spreadsheet. And the reality here is just that. These things are big. They're not small. They may have many different programs, and it's just something that hopefully you're aware of. So, here is just many programs. What happens is, what I've seen, this isn't exactly how it looks because I doctored this up, but they may have like program, this kind of program this far, and this is program A. Sorry, this thing doesn't allow me to write too well, so it looks a little screwy. And then maybe this is program B and that kind of thing. So you can see that, and then that would go into A and B would be like a functional area. A and B here would be functional areas. And then these are subparts of it. These also have CFDA numbers, so they were telling you that some of these items along here are like this. The 93.015 was actually a CFDA number. So, and they had different purposes. So some of these were repeated, and obviously I did that deliberately so people wouldn't know what their real numbers are. But you get a sense of it. All the numbers, basically, except for the headers, are actually real, and the expense line items are real as well. So you notice what happened, just like in the HHS model. Let's go back. In the HHS model, um, here you see, I'm going to use a different color here. This thing, obviously, and I apologize, isn't the most fun one to use, but anyway, here's the financial statement numbers, here's the adjustments, and then here's all the direct costs with indirect way over to the right. If you go back to this thing, you'll see it's the same. Here, these totals are, this is the financial statement. If I can do it, hey, pretty good for me. And these are the exclusions, the unallowables. And so we'd actually have to page down. Here's where some of them sit. These are some of the unallowables. And it's just a variety of small things, nothing really big. You can see things like penalties are unallowable per A122, so you would have to do the same thing. Interest is unallowable. Um, and then up here, advertising. This may have been not related to program, but advertising of a general nature. Um, Donations to like the Salvation Army would be unallowable. Um, I don't know what's in the employee appreciation. That may have been something that wasn't permitted. And then, of course, they had a prior adjustment. And costs have to fit within the right period. So if you had costs that related to a different period than the period you're trying to sell your rates, 2010, they would be removed. So even though this is a big, humongous schedule, you can see that it's set up a certain way. Again, from the top, from the top you see your wages and your, and then down here they group their fringe benefits, and all the rest is other direct costs. And these were the costs under the purple that they even charge direct, like rent. You keep going down, lots more other costs until they get to the grand total. Notice here again, we start with 2.4,609,000. The only amount that they disallowed was, it looks like $8,000 or so. Now there's a reconciliation. Notice this piece here is 2,392,000. At the very end of the spreadsheet, if you go over here into this box here, okay? In this box, you'll see at the top, direct salaries and wages, 1.110. Then the applied benefits is 243,000. That equals the base of 1353 for developing their indirect rate. Then they've got some other direct costs that are not a part of the rate at all, the 825. The G&A pool is 214. You can see above. This is the 214, 290. Okay. If you wanted to find where is these numbers for salaries, we have to go back one slide. And up here is the salary and fringe base, because if you look over to your left, it's total salaries and benefits. That's over here. Okay, so this is the number. It's made up of total salaries of 1110058 and 243008 benefits. And again, if you go to the bottom, 1110058, 243, total base 1353065. And you got the G&A pool of 214. That equals a grand total of 2.392 million. Then you have some unallowables of 8185, and again, guess what happens? You're reconciling back to 2.4 million. Now, we take these numbers over here, and if you go back to the second page, and we'll now show you how we develop the indirect rate. All righty. The base is here. Here, see the 1.1,058. That's the salaries that are direct, and 243,000 is 243,000 is the benefits applied to the direct salaries. That equals a total base of 1353065. That's your base. Your pool was 214,299. That's your G&A pool, and it's subdivided into these components: salaries, fringe, and non-labor, because the government wants to see it. But if you take the pool of 214,299 over 1353065, you get a G&A rate of 15.84%. After all that misery, that's what the rate is. So that's the process here. So going over the spreadsheet again, it's not really that much different in format, although it looks like it, than this spreadsheet here that we use for DHHS and their model. It's just that everything under programs, in this area has been, many, 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 many columns. And what they did, which you don't see here, what I showed you, is they roll up some of those different individual grants into an overall program. And of course, on their audited statements, the auditor made it real simple. They just had one amount for program, one amount for administration, one amount for fundraising, and then they get the total. That's how they did it. Again, remember that there might be internal allocations. You typically see this on statement of functional expense because per GAAP, some of this indirect effort should stay into administration. They don't allocate all of it out. That's their interpretation, and it seems like all audit firms do the same on this. Doesn't matter. Think of it this way. Some of you accountants, there's a cash basis for tax purposes, and then there's accrual basis for book basis, and sometimes accrual and tax don't agree, which is expected because tax is on a cash basis. The same thing here. For this, we're doing this on an OMB basis, and we're removing all this cost out of here, and we're going to apply it to program and fundraising because we can get full cost recovery. So just realize that your indirect rate is going to be a little bit different. So this is a big, hairy monster spreadsheet, but really it's not that complicated. And some of these items and the reasons they were disallowed, you're going to find right down in this little box here. Unallowable advertising costs, removal of interest expense, even though it was a negative, unallowable penalty costs, unallowable donations, unallowable employee gift cards, that's what that was, and unallowable write-off of expenses for prior year because it relates to a prior year. So hopefully you're now getting how this kind of thing works, how it would work for you. You might have a different kind of spreadsheet than this, but in order to do it, you're going to need something like this to do this detail. Now they have spent a lot of time putting the text together as well. And, I've removed some of their description here so you can figure out what kind of organization they are. The cost allocation methodology, a lot of this stuff, a lot of people just, and I hate to say it, what they do is they just kind of, what should I say? They fit it so that it just, it's exactly the verbiage you would see in this thing. So you have to be a little bit careful about it. Okay, so the cost methodology, you got to put in the beginning and ending of fiscal year. This is entirely and completely simple. Again, you notice they keep talking about the proposals based on the nonprofit's audited report, statement of functional expenses here. So you have to understand that this stuff, is important, and you have to have audited statements. There's just no way around it. And then, see here it's saying the proposal addresses all elements of costs incurred by helping hand and identifies shared costs that require allocation. In other words, your indirect is over all the parts of the organization. It can't be broken up. And when you add your indirect to your direct, that represents everything. Then it talks about direct costs. We just put in that we said the direct costs are costs that are identified specifically with the project code. They use P&L by class lists for QuickBooks accounting software. And so things are charged to a project or class or subclass or that kind of thing. And then we use a series of general ledger accounts and so forth. And then the indirect cost is very simple. It's a simplified allocation process. They only have one simple G&A. They don't break apart the G&A between occupancy and administration. They just have one G&A that allocates over the base. So that's how that works. Okay. And then the cost and base distribution, you can see that as well. I have to go down here. So now we had to add some things. Everybody wants to just cut and paste the description, and that's what we're in, the description that you're going to send to HHS. So we start out with everything that's generally done in the first paragraph, but we make it very clear because we want to be proactive with the government. We want them to know why we're not using a modified total direct cost base. So we explain in the second paragraph under E, the G&A cost pool is distributed to various program activities using a direct salary and wages plus fringe benefits allocation base. Helping Hands does not routinely receive volunteer services, so we're anticipating that, and none was included in the base. And then we're saying heretofore Helping Hands had approved federal grant and non-federal budgets that sometimes permitted direct purpose rent and joint costs, and other times they were not included in an internal overhead allocation. And it goes through that. And then it says in developing Helping Hands indirect rate, they wanted to ensure that direct charge rent and joint costs were not inconsistent or resulting in double charging. In order to ensure consistency in the direct and indirect charging of rent and joint costs, Helping Hands elects to use the direct salary and wages plus fringe benefit allocation base, since the G&A rate, which includes some direct purpose rent and joint costs, will not be applied to total direct cost base that would include direct charge rent and thus avoid any double charging. Now that's a lot if you're not used to dealing with these kinds of things and methodologies, but that's really what we're trying to do here. Notice again at the top under F, the first thing we're doing is we've reconciled the total submission cost to the total audited report statement of functional expenses. Okay, there is a little thing here too, if you noticed. Let me put this down here. And it says an internal, right here, an internal allocation of overhead from administration distributed to direct functions was removed in order to determine the entire amount of G&A expense. What were you talking about there? We're talking about this, right here. They had an internal overhead allocation, which they did per GAAP. We removed this credit, so then the total here is the grand total, which includes 22 and which includes 125 and 99, which is about 224, 225,000. So that's what we're starting from. In other words, we're going to allocate all G&A expenses, and that's what we meant by that. And then salaries. Now here you're actually seeing an organization as we do all the salaries here. Now, unfortunately, they put in the name. I should have proofed this, but of course I removed it and redacted the names out. They didn't need to put in a name. But these are all the people that charge G&A wages, which is 56.4. 56.4, I just want to show you. Ooh, it's real small, but we can find it right here, 56.4. So that's where that is. The government wants to know who is charging to G&A administrative pool, which then gets eventually charged to grants. So yeah, you would have an ops manager, deputy director, executive director, and some admin people, and so forth. These were the people that did it. This is their dollars and their percentages during the year. And the way we got the percentages of their total time was we put their total salary, and this is the part that they charge. This is their total salary, and this is the percent of their time. Fringe benefits is no different. That's what we did below here. Okay, hold on one second. I'm trying to reformat these things so that I can see. And they just wanted a detail of fringe benefits, which you got to go to the next page, which is 27424 right here. And then they want to know the details of the non-salary, and it's just you're just breaking up numbers at this point. Now, the base here of 1353065 agrees with the base back in the spreadsheet. The detail of this isn't quite the same because I had to change and doctor up some of the numbers. But the 1353, that is right there. It's this number right here. That's direct salaries and direct fringe of 1353. That's where those numbers came from. So you can see we're not making anything up. Everything reconciles. These are the components of the G&A, which we showed you before, and it equaled 214,299. The rate is 1584. Now, it's very important that you understand this section L. Section L normally is you're stating to the government, we had so much money available that we put as a line item in various federal grant proposals, and the government's saying if you don't have enough money, you can only recover what money you have that's left in your federal awards that's dedicated to indirect. What they're saying is that this is the first year that they got an approved indirect rate, or that they're submitting for an approved rate. Therefore, they don't expect none of their proposals have an indirect, or none of their grants have an indirect rate in it. So all they're basically saying is this is just for the purpose of negotiating a provisional rate. The provisional rate will be used in proposals for awards, and once they're awarded and you have indirect permitted to be recovered in a grant, then in future periods you can then get recovery of those costs. Right now, this is for a future perspective. It's not in the current year. So even though you may get this negotiated, still you can't do anything with it. This Schedule B is very simplistic, and what they're saying is that supplies is basically allocated as direct or indirect based on the charge number on the PO, as on the charge number in the PO. So basically what they're saying is if it's a direct purpose supplies, it's charged direct. If it's indirect purpose supplies, it's charged indirect. The same for duplication. For telephone, long distance, they're tracking the cost by code, postage, and equipment. What they're basically saying it's tracked as direct or indirect based on either a postal log or based on the type of expense or the purpose. Communications is tracked direct or indirect based on the code, if it's a long distance charge or charge number. Software generally is direct or indirect based on the charge number, and so is so many of the others. The only one here that really differs is depreciation. Depreciation is 100% and can only be recovered as an indirect charge. Depreciation is only recovered as an indirect, as a part of your G&A. That's why many of you are not recovering some important infrastructure costs because you have no G&A. The same with your occupancy. Consultants, they're identified as direct or indirect based on the scope or purpose from the consultant's agreement. So that's how they handled and described this thing. So that may give you some more insight. Now we're getting down to the basic checklist. This is what we saw before. This is how they had identified it. And you can see again, one is, does it reconcile to the financial statements, the audited statements, and the emphasis on audits. I know some of you that are looking for assistance, you all three have audited statements, so because you said you're in the process of waiting for your audits to be complete, which is great. And then they want to know, number two, did you reconcile? Remember back up here? Yep, I went too far, excuse me. Right here. Do these two numbers reconcile? Does the audit report of 2.4,609 agree with the total cost in your proposal? And of course, you may have to remove unallowables. They understand all that, but does it essentially agree? That's the question they're asking you. Then do you remove any unallowable expenses? Obviously, you're removing things from the numerator that would make the rate lower. Number four is, did you include everything in the denominator, such as fundraising, project cost sharing, voluntary, in-kind contributions, those kinds of things that makes the number bigger. I'm surprised they didn't put research and development in there, because if you had any research and development, that would go in there too. Did you do a functional analysis of the wages in the indirect cost pool, which you did? Remember that? That was done up here, right in this area. Whoops, sorry, in the G&A line here. It's hard to move this thing and make it work right. So, paid absences, such as vacation. They're assuming you're keeping it the same and that it's in your wage line. 7, were there any changes in this proposal versus last year? Did you do any cost accounting changes? Are there any changes in how you allocate your costs? You know, that's a very, very important thing to do. Another thing they're going to ask you is, did you change your equipment capitalization? And they want to know what your current equipment capitalization is. This organization is very low at 500. The max is 5,000 per the government. And then do you have the attached lobbying certification, which basically says you're not using any direct or any indirect costs for the purposes of lobbying, which of course is unallowable. Finally, the final product that you're going to get out of all this is you're going to get this rate a submission agreed to. They call it a NICRA, a Negotiated Indirect Cost Rate Agreement, and this is the page that they work so hard to get. And so you can see from this period of 11/1/2011, because they had a 9/30 year end, to this they used the rate of 1584. And then they're saying from this point on until amended, the rate stays the same, 1584. And then they're saying the basis for this is direct salaries and wages, including all fringe benefits. It's not a modified total direct cost, so the rate's obviously going to be a little bit higher. And that's how this turns out. They work very, very hard to get this rate this way, you know. And now they can use this rate in proposals going forward, but until they win awards, the key is until they win an award, and then they've operated on that award for a particular year, and then settled a rate for that particular year, then that rate can be used for recovery. But until you can put it out in the proposals and get it approved as a budget line item for indirect going forward, all the historical, there is no indirect rate recovery, only going forward. So hopefully that makes sense to you. I'm going to go back now. So we have looked at reviewing the HHS format. We looked at an audit schedule, a functional expense. We looked at post-award trial balance. We looked at the proposal, the text part, and the negotiated indirect cost rate agreement. So, you know, whoops, sorry, I went the wrong way. Okay. So, are there any questions at this point? I'll turn it back over to the host.
With the most. This is Jamie here. I'm going to go ahead and unmute everybody's lines. So if you have a question, feel free to ask Paul. You're unmuted now.
Hi, this is Donna
Silence.
from AIDS Project Hartford. I just have a question. When can you apply for an indirect rate? Anytime, or do you have to have a grant in process?
Good point. You must have you must have an actual award. So you have to have one federal prime, or it could be a subaward under a federal prime. But you have to have some federal money already awarded to you. Without that, you cannot apply.
So when you apply for that, or you do a budget for that existing award, you can't use an indirect rate then.
No, not until you've gotten an award, then you've gone through the process of making a submission. Technically, you're supposed to say you got an award, and it happened October 1st, 2012. By December 31st, 2012, you're supposed to make a submittal to the government, so then they can at least give you a provisional rate. And then going forward, like I said, it takes a while, so you have some awards with that rate in there, and then you can get recovery. So yeah, there's a little bit of delay of time to get it.
Okay. Yeah, it seems a little
Recovery.
backwards, but
That's just the way they work.
okay.
Good
Thanks.
question. Thank you. Any other questions? Don't be shy.
Okay. If there's no more questions, we'll give just a couple more seconds if anybody can think of anything.
Great.
Okay. Well, thank you, Paul, for the presentation again today and for taking part in this webinar series with us. As you guys are aware, once this presentation closes out, there will be an evaluation that pops up. If you could take a few minutes just to complete that document, so we can to help us improve our presentations and webinars here moving forward. Thank you very much again, and we will be talking to you folks shortly. I also will email out the slide sets and documents that Paul was referring to. So if you don't get them from me, you can give me an email at Jamie, Jamie, @healthhiv.org. Thank you very much.